Looking ahead to the week beginning September 16th, it's all about central banks because we have rate decisions from the Federal Reserve, the Bank of Japan, the Swiss National Bank and the Bank of England. We also, in this video, run down the key economic data releases for the coming week. It's worth noting that in terms of a backdrop for markets, the US and China both offering tariff concessions or goodwill gestures, as Trump put it, and organising talks for October has helped improve sentiment recently, with Asian shares particularly hitting their highest in 6 weeks. Naturally, haven assets have gone into reverse with bond yields rising and gold slamming back below the $1,500 per ounce mark. As far as the economic calendar this week, the main events are the central banks, but outside of that, we start the week with important data out of China, where both retail sales and industrial production are both expected to have seen annual declines in August. Bad data is these days bad for two reasons. One, for global growth, because China is such an important and large economy, but two, it emboldens Trump and his team in the trade negotiations, which I think makes a deal less likely, just because in authoritarian regimes like China, the politicians don't feel the same kind of political pinch that perhaps you would in a more democratic society. So if the economy is slowing and working people are feeling it, it doesn't necessarily mean that Chinese trade negotiators are going to feel any pressure to ease up and come to a deal with the US. So the more emboldened the US is, the harder the deal the US is pushing for, that I think makes the deal less likely. There's also CPI data from the UK, which, given the politics, probably won't impact the pound very much. And from the Eurozone, there's also CPI data, and that follows the ECB decision last week. You could say that the rough position we find ourselves in is that for a while now we've had the headwind of the economic cycle, which has been in a 10-year upturn and is due a slowdown, and then we have the tailwind of central banks who could add stimulus and prevent the downturn. And I say add stimulus, there's already a distinct amount of stimulus in the system with very low interest rates. They could prevent the downturn, or at the very least they could delay it. So hence the importance of the central banks this week. For stock markets to keep pushing higher, investors need to feel comfortable that central banks are intervening, or ready to intervene at least, with lower interest rates, and where interest rates are at zero, more quantitative easing. Specifically with the Fed, after the disappointing NFP this month, I think that gives them the room they need to cut interest rates. So a rate cut in September looks pretty set in stone. No cut or a bigger cut would be the kind of shock outcomes as far as the decision itself. But as usual, the tone of the press conference will be more important. The Fed will not want to box itself into a corner with continual rate cuts. But on the other hand, it has the US president tweeting that rates should be cut to zero or less. So literally the US president calling for negative interest rates in the US. So that obviously is a huge political pressure on the Fed. But while trade tensions are still relatively flared up, we think probably that's enough of an excuse for the Fed to signal another rate cut in October. After that, I think it becomes a lot less clear what the Fed does, because still the US economy looks pretty solid. So if we are looking at the signal from the Fed this time around of another rate cut come October, that should be positive for equities. Short-term negative for the dollar. Obviously, it's relative against what the other central banks are doing. Some weakness in the euro should be expected because of the ECB. And we suspect positive for gold, not because it's going to benefit as a haven if equities are rising, but more just because of that weakness in the dollar. And now to cover the ROW team as far as central banks go. First up, currency-wise, things are looking a little bit brighter for the Bank of Japan, with the yen weakening over the past couple of weeks. The pressure had been mounting on them to add stimulus to combat that strong currency, which is seen as a big negative for Japan's export-led economy. Arguably, some of the yen's recent weakness is in fact speculation about that extra monetary stimulus, a bit of a chicken and egg thing here really. One possibility is a so-called reverse operation twist, where the central bank moves to cut short-term rates while supporting longer-term ones. So that would free up the economy a little bit to improve in the short term, but also wouldn't squeeze banks and help banks survive that short term lower interest rate environment. So we think further cuts from the Bank of Japan are coming, but Governor Kuroda last week saying that lower rates are always an option sounds like it's not coming this month. No action in isolation is yen positive, but if the Fed cuts and the mood in markets is positive, we think the yen weakens anyway. There's not too much to add on the Bank of England and the Swiss National Bank, only to say that the SNB is just a prisoner to what the ECB does, so will just match the latest policy move in the Eurozone, and the Bank of England has its hands tied by Brexit. That's it for the video this week. Thank you very much for watching. And if you do enjoy these, feel like you get some benefit, then of course follow myself and LCG on YouTube and social media.